Portfolio optimization is where the major money is made for the investor and where the major money is made for the real estate agent. It allows people to transact a lot more, but way more importantly, it helps people build that long-term cash flow that this product is famous for offering. And so that's what I'm going to break down for you guys in this little segment, let you know all the pieces that you need to look at to compare what your portfolio is today versus what it could be. All right, so with portfolio optimization, the first quick and dirty thing that we're going to look at is value versus rents. And so we talk about this a lot, but we're always trying to hit that 1% rule for ourselves or for our investors if we can. That doesn't have to be the scenario. So just understanding what all the pieces are and how they math out for you, for your investor, that's the whole deal. They may only want to hit 0.7 and be in a super awesome area. Great. God bless everyone. They can do whatever they want, but understanding the pieces is the important part. And so what we're looking at here first is our asset value versus rents. And so if I have a $550,000 property in value and I'm getting $2,250 a month in rents, that's a 0.5 per month multiplier, right? And so I'm getting 0.5% per month in my rents versus my value. That's going to be a pretty common number that we see in our market today. And so when I look at this, I'm able to say, okay, you're getting 0.5% per month in rents versus your value. That gives us a pretty good indicator of whether we can help you from a cash flow basis or not. So that's the first thing that we want to look at, and that'll give us a pretty quick indicator. So if I have somebody tell me like, hey, I've got 4 rental properties and they're worth $3 million, and then I'm able to say, okay, great. What are your rents? And that makes it really quick and easy for me to say, oh, your rents are $17,000. That's 0.55 or 0.53 or whatever that is. Like, I know right up front, super quick, I can do better for you. And so that is an important part. And then so there's lots of other pieces that we're going to go over that make a difference as to whether or not that's going to add an extreme amount of value or only a little bit amount of value to them. But long term, when we look at cash flow or rents versus value, that's the first piece that's a telltale sign how much we can help ourselves or help our clients. So point number 2 that we need to look at for the portfolio optimization is we want to look at our debt and our payment. So many times I'll sit down with people and they're like, wow, I've got a 3% mortgage rate. And I'm like, yeah, I don't freaking care. It doesn't matter to me. I'm looking at the whole scenario. Let's look at what your portfolio looks like totally, and then we can make smart decisions. So with this property, this scenario at 550 value, I've got debt on that property of 100 grand. This is actually a real scenario that I'm running here, that we have a client that we optimize for. And so $100,000 mortgage is what they had left owed on the property. And so that means that we have about $420,000 in equity after cost to sell on that property. And then we've got a payment on this property of $900. And then after taxes and insurance, that ends up being a cash flow of about $1,050 a month on this property. So that's what I want to know. I want to know, after everything's said and done with my low taxes and insurance, cool, what does that translate into for me in cash flow? And so I've got 420 grand that's chilling, doing nothing except for making me $1,050 a month. So what's my return on investment on that money? It's about 0.25. So I'm making 2.5% on my money, on my equity. And so don't love it. So let's see what the other factors are that we go through to determine whether this is a worthwhile property to keep or whether it's time to optimize and get rid of this one. As I'm going through these numbers, like I just threw out, this is about a 2.5% return, like on the money. And so I want to dial down on that and say, okay, how did I figure that out? Well, all I'm doing is I'm taking this $12,000 a month in cash flow, and I'm dividing it by my equity of $420,000. And so when I take $420,000 and $1,000 a month, that's really $12,000 in annual cash flow divided by 420. And so I'm just doing 4 divided by 1. That gives me 25%, or I know because it's only 10,000 on 420, that ends up dividing into another decimal point. And so that gives me about a 2.5% return. So knowing what this number is very powerful. How much equity is there, and how, like, if you had that equity in a bank account, what would you want it to be producing for you, right? And so that's how I'm always looking at this stuff when I'm talking about portfolio optimization. And so that's how I did it. I just took my 1, divided it by 4.25. That's what I got. So anyways, that's how I've come to that number. So the next point that most real estate investors appreciate and love is the depreciation expense. And so understanding where their portfolio stands with that is super important, because that tells you how much tax-free money that they get to make every year, right? And so as we're looking at this, we say, okay, depreciation expense on a property that they paid $120,000 for 10 years ago or whatever that is, it's going to be much lower than it could be if they replaced that property. So what we use for depreciation expense is a multiplier of 0.8. Basically, you get to depreciate the value of the structure, and so you have to assign a specific value to the property. That gets done by the tax guy. There's, you can look on the county tax assessors to see what portion of the value is being assigned to the land. It doesn't necessarily get done that way every time, but for a quick and dirty, we use 0.8, or you can look at their tax return. In general, to help them understand the concept, 0.8 is fine, saying that 0.8 of the value of this property is actually the structure. And so with 0.8 multiplier, meaning 80% of the property is actually what can be depreciated, you get $96,000. And that's a number that they started out with when they bought the property. So 96,000 is what they get, and then you get that depreciation expense over a time frame of 27 and a half years with residential property. That gives you $3,490 per year in depreciation on their current property that they have. That's the tax-free money that they get to take off of the income that they're making on that property, which in this scenario represents about 3.5 months worth of income that they're getting that they aren't paying any taxes on. So important factor to consider. And when we go through the end scenario on this specific property, then I'll be able to show you how that affects them long-term by optimizing. All right, so what we're doing now is we're gonna go through with them the benefits and look at what that looks like at current opportunity costs. Like, what does that mean within this year by the time we change this up, 1031 from the property that they have and put them into a new property? So the current opportunity cost. So they currently have $420,000 equity. We can use that equity to do 2 triplexes. Now, it may not quite work out that way, but pretty close. So that will give them enough money to come in and do 2 of these projects. And that will put them, currently they're at $1,050 a month in cash flow. That'll take them up to $5,000 a month in cash flow. That's $2,500 net on each of these 2 triplexes that they create. And then their current rent roll is $2,250 on their current property that they have. And that will change to $12,000 rent roll. And that's going to be $6,000 per triplex. And that's going to be their gross rents they're going to receive. And so they're going to go from a $550,000 current value after they buy the 2 triplex properties. They're going to be at $1,500,000 in value, because each of these triplexes is going to be worth $750,000. And so, and then lastly, so we've also, by doing that, they're only invested in these by about 600 some odd thousand, 620, 630, 640, somewhere in that range. And so they've actually forced a couple hundred, maybe $250,000 of actual value into their portfolio. So they've just increased their net worth by doing this by about 250 grand. That's a pretty big deal. And then lastly, their current depreciation expense on their properties are roughly $3,400. If you go back to the other slide, you'll see the exact number. But by leveraging into this portfolio, they're going to get $17,490 in depreciation expense per year per property. So that's now $34,000, $980 per year in depreciation expense. So that's a 10x on their depreciation by buying a bigger asset. So that's a really big deal. The first $34,980, so 35 grand that they make, is tax-free instead of only the first $3,400. And they're actually creating enough cash flow that matters to them. So that's a big deal. So how do I get to that number? Really simply, I take what they've already depreciated out of their other properties. So say that they had 96,000, they've depreciated about 30,000 out of that so far. We subtract that off of what the calculations that we did the last depreciation expense would be. So basically we're gonna say, okay, now we get to depreciate $1 million or $1,200,000 or whatever that number is. And then we're gonna say, but $30,000 has already been depreciated off the current property, gets knocked off of that. And so that's how you calculate what that is. And overall though, 30,000 here or there, in this scenario, it means next to nothing. The bottom line is what you're showing them here is that your depreciation expense goes way up. You're able to save a lot more of this money on an annual basis. You're making a lot more money, but you're also paying not that much tax on the money that you're making extra. And so that's a major thing. And so then now what we're gonna do is we're gonna move into what does this look like on a 10-year timeline if they do this, or if they just sit still in the safe little warm cocoon that they have right now of their current rental property. All right, portfolio optimization, long-term, we're gonna go into this quick and dirty. Today it's $550,000. That turns into $1.1 million at a 7% appreciation rate, or $2.2 million in 20 years from now in value based off of that 7% appreciation rate. Or if we optimize, it's $1.5 million in value today. 10 years from now, that's $3 million in value, or $6 million in value in 20 years from now. And so the difference between those is huge. That's almost $4 million, big deal. Rents, $2,250 today at current rents. They stay the way that they are, $4,500. And then in 20 years from now, they go up to $9,000. Now that's net rent, which is an important factor in this based off of their lower mortgage. In 10 years from now, they're at $3,300 a month in cash flow. And there's a big jump when they pay off that mortgage in the next 20 years. That puts them up at $8,700 if they just stayed doing what they were doing. Or they go to $12,000 a month now, and that is $24,000 in 10 years from now, $48,000 in 20 years from now in total rent rolls. But their net, because of the higher mortgage, is $17,000 in 10 years from now. That's $41,000 in 20 years from now. And so the nexus between these numbers is ginormous. Like that is a big deal. $34,000-ish in additional monthly cash flow just by making this little switch. And so that's a big deal. And then equity. Like let's look at what the value is. $420,000 in equity today. That's $1,070,000 in 10 years from now if they just hang out. $2.2 million in equity because they've paid off the mortgage in 20 years from now at that point. So 2.2 value, 2.2 in equity. Or if they make this current switch, they're going to go from 420 to 650 because they've added value to their properties. their equity in 10 years from now is $2.3 million. And then on a 20-year timeline, we go to a $5.530 million equity position. So we've more than doubled what they would have in equity by making the simple switch, as well as the significantly higher cash flow, as well as the depreciation expense and all the other benefits that you get from this. And so this portion is the sales pitch. This portion is the value add. And if you can help people that have 2 or 3 properties like this, that sit in this situation, which these numbers are based off of somebody that we did this with 3 properties. So what does 3 properties look like for us? As agents, that looks like 9 transactions, because they're selling 1 property that we get to sell for them, and then they're buying 2. Well, you do that 3 times, that's 9 transactions. That's a big deal. And we've created a great portfolio for them where they're making a significantly higher cash flow. And these are the things that help us to rinse and repeat and do a lot of business with a few people, helping them build their wealth, or doing this once again, even with our own portfolios and building our own wealth. So for those of you that are real estate professionals as investors, or that you have clients that designate as real estate professionals, like, this is a major benefit too. So basically with cost segregation, those of you that don't know what that is, that 27.5-year depreciation that you get to take on these properties, you do have the ability to accelerate that. And you can say, hey, I'm taking a major portion of that in 1 year. And so this year, I've cost segregated a couple properties on my taxes that have created a $400,000 loss for my tax bill this year. And so that's saving me, in my scenario, a significant amount of money on my taxes. So if you're designated as a real estate professional, you have the ability to do that. And the way that cost segregation works is basically you can get a study that says your property's value of depreciation is $450,000 or $500,000, but this portion of it, the plumbing and the electrical and all these different things, represent $200,000 of that value. And if that $200,000 you get to take as a one-time expense, there's people that do those studies, but for your high W-2s, or for your people that are making mid-6, or low 7 figures, people like that, it's a major benefit for you to be able to wipe out a whole bunch of income on a 1-year timeline by using this cost segregation. There's a lot of nuance that goes into that. Your accountant or tax attorney can help you with that, but this is another major benefit that we use for ourselves, and that we've also seen a lot of benefit for our clients. The client that we ran the scenario on this actually did that for themselves this year. They cost segged and they wiped out their tax bill completely. I'm not paying taxes this year, and I love it.